What is contango in commodity markets? Breaking news for investors. The question on many minds today is, what is contango in commodity markets? With recent fluctuations in commodity prices, understanding this concept is essential. Just yesterday, analysts noted significant movements in oil and natural gas futures, making it a hot topic among traders and investors alike. Contango is a market condition in commodity futures. In this situation, the prices of futures contracts are higher than the expected spot price of the commodity at the time of contract maturity. This means that contracts for delivery at a later date trade at a premium compared to the current spot price. Essentially, the futures curve slopes upward, indicating higher prices for longer-dated contracts. Investors often see contango when there are costs associated with storing the commodity. These costs can include warehousing, insurance, and financing. All these carrying costs are factored into futures prices. As a result, futures prices end up being higher than the spot price. Contango can also suggest expectations of rising prices or potential supply constraints in the future. This market condition is the opposite of backwardation. In backwardation, futures prices are lower than the spot price. This situation usually signals tight supply or expectations of falling prices. For those investing in commodities, understanding contango is vital. It affects the returns on futures-based investments. When rolling futures contracts forward, investors may face losses if the market is in contango. This happens because they sell low and buy high, leading to what is known as a negative roll yield. Grasping the concept of contango helps investors anticipate costs or gains when trading futures or commodity exchange-traded funds that utilize futures contracts. In today's market, where volatility is common, being aware of such conditions can guide investment strategies effectively. In summary, contango is a common futures market structure where longer-term contracts are priced higher than near-term contracts. This pricing is primarily driven by storage costs and market expectations, making it a key factor for commodity investors to consider.